Thank you, Nudia. Great information. Now, welcome to our next session, Keeping Current Matters, Affordability, Interest Rates, Housing Inventory Shortages. We're going to hear from two experts on who will share strategies and a collection of 2022 insights and analysts and discuss how real estate professionals can better prepare and not use their knowledge to position themselves as trusted advisors for future borrowers. Our speakers will highlight key data points that highlight opportunities, gaps, and relevant insights to help understand the current state of affordability and how to embrace the affordability mindset. Our first speaker is Dr. Jessica Lautz. Dr. Jessica Lautz is a Deputy Chief Economist and Vice President of Research at NAR. The core of her research focuses on analyzing trends for both NAR members and housing consumers. Through management of surveys, focus groups, and data analysts, she presents new and innovative ways to showcase results. Jessica discusses research findings in major media outlets and international presentations. Jessica received her doctorate of real estate from Nottingham Trent University in the United Kingdom, and she also holds a Master's of Public Policy from American University and undergraduate degrees in poli-sci and law and justice from Central Washington University. Joining Dr. Lautz is Dr. Lariece Brown. Dr. Lariece Brown is a principal economist and senior director at Freddie Mac's Single Family Mission and Community Engagement Division. She leads a team of conducting analysts and research for underserved markets. She has an extensive experience in research in supporting fair lending, affordable lending, and access opportunities to expand access to credit. She earned a MA and Master's in mathematics and a PhD in economics from The Ohio State University. Jessica, I'll welcome you to present your research.
Thank you so much for having me. I'm really thrilled at this opportunity and to share the stage with Dr. Brown as well. Thank you so much. I wanted to share three recent stats that we have released here at NAR. And I have to say that I titled this three striking stats, but at the same time, we're hearing so much misinformation in the media right now about what is really going on when we talk about real estate. And there's a lot of inaccurate comparisons being made to the boom and the bust era. They're being made to a time period that is very, very different from today. We know that there are incredibly tight lending standards, and we know that you have to have a high income. You have to be able to have money in reserves and a solid down payment to be able to qualify for a loan today. We also know that this environment is incredibly unique because we have such limited inventory. So if we look at today's housing market, we have give or take about 1 million homes on the market on a monthly basis available for sale. And if we look at back at that time period, we had 4 million homes on the market. So a very different time period right now. And unfortunately, the inventory crisis doesn't seem to be going away overnight. We know that building has been down, and it has been down for over a decade now. We're short about 6.5 million homes for the available consumers who would like to move in and live independently and purchase a home and earn that housing equity. And at the same time that we have this limited inventory, we also know that people are aging in place, and they're aging gracefully, and they're staying put in their single family homes, and they're staying put in their condos, and there's really no intention of moving at the same time that household formation should be off to a running start with young adults. All of that said, what I want to show you is some data that we have just released on who's entering the housing market and really how that has changed in the last year. So moving into the first slide here, what we can see is that first-time homebuyers are down. They're encountering this incredibly limited housing inventory environment with these affordability constraints, such as rising home prices at a double-digit pace in many areas of the country last year, at the same time that they're now encountering rising interest rates, jumping to 6.5%, where they stand now, up from 2.5%, 3%, which they could have had a year ago. That's a very different lending environment. And the first-time homebuyers are not just encountering issues within the housing market, it's also problems outside the housing market, such as the rise in student loan debt, or the rise in rent, and the availability to pay that down on household incomes, which are not able to do so, and then save for a down payment. At the end of the day, that goes to the back burner for many households. When we look at this chart, what's pretty striking is not just that the share of first time homebuyers has dropped to this all time low, but also if we make any comparisons here, we should be looking at the 1980s. And the last time it was even close to this low was at 30%. And that's back when we did have double digit interest rates, not 6.5%. If we look at the high water mark there, the 50%, that was the first time homebuyer tax credit. And we had a lot of available inventory at that time period. And so we did have that tax credit, and that helped first time homebuyers into the market. Since then, though, we have had under 40%, and 40% would be the average if we look over this time period. On the next slide, I want to show you just how different these home buyers are today as well. When we look at first time home buyers, the age has actually risen to an all time high of 36 years old. And that's the highest we've actually ever seen it in the data. It usually stays within a pretty tight bracket of 28 to 33 years old, really doesn't move very much. It's a pretty boring line until we get to the last year where that age has jumped up to 36. And of course, those headwinds inside the housing market and outside the housing market are really delaying these first time home buyers from purchasing. What's really notable, though, is when we look at these first time home buyers, those who can enter are likely to have generational transfers of wealth. They're likely to have mom and dad's help or family help. 22% of them had down payment transfers from their friends or family. That's about the norm. When we look, though, and look a little closer and where they're moving from, this is where it gets really interesting. 27% of first time homebuyers moved directly from their family member's home into home ownership. Now, the pandemic could have given them that ability to do so because they didn't have to live close to their city center where they were renting. And this freed up their ability to really move home, perhaps to their hometowns and skip rent. But that really does speak to really a separation of haves and have nots in the housing market among those who can do that and those who can't. And those who do have those generational transfers of wealth or do have that generational support to move home are the ones who are entering the housing market today. The other trend that's really important here when we think about the lack of inventory and we really just think about this generational divide that's happening in housing right now is the age of repeat buyers as well. The typical age of a repeat buyer back in 1981 was 36 years old, the same age as a first time home buyer today. If we look at the age of a repeat buyer now, it's 59 years old. And outside of the pandemic, we know that people are living longer and working longer. They're feeling confident taking on a mortgage later in life. But this really does have some pretty big implications among those who have that housing equity and can enter the market and are doing so confidently, buying a nice single family home, perhaps, and doing so at a later age than we would have seen traditionally. On the next slide, when we talk about money, I think it gets really important too to talk about those all cash buyers. We know that it's a significant portion of the market. In the last year, we've seen consistently about a quarter of the market is paying all cash. And when we look at repeat buyers, they're doing so in a way that they hadn't in the past. Among primary residence buyers, these aren't investors, these aren't vacation home buyers, these are primary residence buyers. 27% of them paid all cash. And that's the biggest share we've recorded dating back to 2003 when this data set started. So it really does speak to a different type of buyer who has that housing equity. And we know that people stay in their homes for about 10 years. And if someone purchased their home 10 years ago, they have about $210,000 in housing equity. And that allows them to make a purchase and perhaps do so with all cash, especially if they're moving a farther distance away, which is another thing that we found as well. Verifying what we all know has happened during the pandemic, people moving farther distances for affordability, to be close to friends and family, and just to have a different way of life. And we certainly have seen that as well. For first-time home buyers, that's pretty much out of reach. Just 3% are paying all cash. The vast majority are financing their purchase, some taking advantage of FHA loans and VA loans. But unfortunately, in the last year, because of the competition in the marketplace and the stiff competition, they really have been shut out of the marketplace if they had an FHA loan or a VA loan. But now, because we have seen a contraction in the real estate market, because home sales have been down over the last 9 months, it is a possibility that these first-time homebuyers might be able to come in and might be actually able to compete again because of really this retreat in the marketplace. That being said, they have to have a higher income to be able to pay that higher mortgage with that higher rate and also that continual rise in home prices, which we do expect into 2023. So that's all I have for my content. But I am excited to share this information, and we want to get this information out there to you. So please do follow us on social media. We're posting new content on a daily basis. And I really do thank you for this opportunity to be here with you today.
Great insights. I mean, we could definitely see the impact in the changing markets from what we've experienced in the last few years and what we've been going through in the last 6 months. So, what can professionals do to make it easier for first-time home buyers now and in the future?
Truly, I think it comes down to education. You want to get that information out there about those low down payment programs that could be available that they could qualify for. I talked about the FHA and the VA loans, but so many local communities have programs to help first time homebuyers. Those go under the radar. People don't know about them. Getting that information out there, telling consumers what an actual down payment is, 6 to 7% versus what they think they need, maybe 20%. That misinformation is out there, the myths are alive, and getting that information out there into consumers' hands, I think, is incredibly important to bridge that gap. So we don't just have to rely on the bank of mom and dad, which is just not available to so many people.
Absolutely. And that's what everybody's doing here today, gaining education on how they can reach more home buyers. I'd like to turn and invite Dr. Brown for her presentation now.
Thank you so much, Monica. Thank you, Jessica, for all of those insights. And I'm going to pick up pretty much in the same place where Jessica was talking about some of the challenges that we're seeing on the affordability front in our data and in our research. Let's go ahead and plunge right in. I want to lay out in this first slide here, this next slide, our construct for this. Again, I want to thank everyone who's listening and participating in this conversation. The fact that you're here is very important so that you can take this back to your clients as you work through these affordability issues in particular. But I want to talk a little bit about, first of all, how we think about who may be challenged and what the opportunities are and what those challenges are. In our research, we use a mortgage-ready construct to broadly define buckets of consumers for our analysis. Today, I'm going to primarily focus on what we call the mortgage-ready consumers, those who are potential future borrowers who are without a mortgage, but with credit scores above 660, non-mortgage debt, or to income ratios of no more than 25%, and no foreclosures or bankruptcies within the past 7 years or severe delinquencies within the past 12 months. And this, again, is just a construct to help set the stage of a conversation around who's mortgage ready today and what challenges may they be facing and what are the opportunities for us to serve these currently mortgage ready consumers. We also do research to understand the near mortgage ready as well as the not currently mortgage ready. But let's focus on the mortgage ready bucket for just a moment. Within the group of credit visible consumers who are 45 years old or younger, we identify 39.2 million mortgage ready consumers, those who do not currently have a mortgage, but broadly speaking, represent those most likely to be able to qualify for a mortgage in the near term, not having the full data to do the underwriting. Let's start with this important group, again, that 39 million consumers, and talk about some of the challenges they may be facing today. I have a graph in this next couple of graphs in this next couple slides here that I want to talk you through. So, rising interest rates, higher house prices coming out of the pandemic, coming out of COVID-19 pandemic, we're seeing home sales declining as these home prices and interest rates continue to rise. Freddie Mac is forecasting annual home sales to decline from 7 million in 2021 to 5 million by 2023, a decline of approximately 30%. And here's part of the story. I'm going to start off with our middle income consumers first, and the middle income mortgage ready consumers in this particular chart. All right. The middle income renters, the story is particularly interesting here. Let me walk you through the chart a little bit here. In the chart, in the line graphs that are the colors above my green line, I'm showing you the budget for what middle income consumers can actually afford based on the interest rates that are prevalent for them at that particular point in time, going back to April of 2021 and working until July of 2022. The blue line, the second from the top, would include, we're breaking this down by race and ethnicity as well, includes non-Hispanic white Americans. If I look at the blue and gray line, the third and fourth lines from the top, we're talking about Black consumers and Latino consumers respectively, and what is affordable to consumers looking at their individual budget based on a back-end debt-to-income maximum of 43%, 3% down. I'm going to talk about that a little bit more in a moment, on a 30-year fixed rate with the typical interest rates for that time period. Those lines were steady for a while, and then by 2022, you see they're declining at some around January from the first quarter of 2022 through that second quarter of 2022. The green line, to contrast, shows the median single-family home price during that same time period. So while budgets are decreasing, available budgets to purchase a home are decreasing, the green line is showing that house prices are in fact increasing. Budgets are decreasing because of the interest rates that will, in terms of what you're going to be able to purchase. Middle income, we see the challenges starting to show a little bit there as well. In fact, what we find out is that based on recent high mortgage rates, which are nearly 7%, and current median home prices of approximately $400,000, only 12 million mortgage-ready potential home buyers have the capacity to afford mortgages right now, compared to 26 million when the rates, excuse me, were 3%. Why is that? Let's take a look at this next chart to really dive into where the struggles may lie. This is the same chart that I was talking about in the prior slide, restricted to consumers with incomes that are no more than 80% of the median income within their metro area. Now, again, using the same convention where the blue line is for non-Hispanic whites, the orange and gray lines for Black and Latino consumers, you can see all of these lines, again, because they're declining, going into these more recent time periods starting in the first quarter of 2022. When I compare that to the single family median home price, which is increasing over that same time period, I now see a point of intersection in 2022 where the affordability is extremely challenged, right? So showing this for lower income consumers, we see that the lower income consumer is far more likely to be house budget constrained. Let's take a look at the geographic distribution, this next slide I have here. So here I want to look at the map. There could be some differences across geographies, and there tend to be quite a bit of diversity across our country in terms of house prices and income. So let's take a deep dive there in terms of where affordability may be challenged. Jessica mentioned, challenges in house supply, that housing stock, in addition to these house prices and interest rates. In order to read this map, what I want you to see is that the red is to reflect less affordable areas, the green to reflect relatively more affordable areas. We've developed this index or map of values to show you what this looks like. Excuse me there. The size of the bubble is for the number of mortgage-ready consumers in the metropolitan area. So the larger the bubble, the more we have of the consumer base of potential consumers who are more likely to be in a position to qualify for a mortgage who do not already have a mortgage in their credit profile. You can see from the map on the left side with all consumers there, right away, your coastal areas have a higher count of mortgage-ready consumers, but you also see a lot of red, especially on the West Coast and then that Northeast coast, right? Mortgage-ready consumers are there, but these geographies tend to be less affordable for their mortgage-ready renters. So this is restricted to renters. The Midwestern and Southern states are more affordable than coastal areas. And going into 2020, even the Midwestern cities and Southern cities start to see some challenges there. On the right side of this picture, my right side of the picture, again, I restricted to those consumers who have incomes that do not exceed 80% of the income in their geography, their median income, low to moderate income consumers. Now, more of this map is going to be orange and red, with a few pockets in the middle of the country that remain more green and yellow, therefore indicating that we're facing more extreme affordability challenges for this group. Stay right here for a moment. Opportunity. What do we do about all of this information? And just instead of just saying we're doomed, we do recommend deep diving into where are the opportunities, what are the ways to overcome that through understanding down payment options. Jessica brought that up. I want to piggyback on that. Down payment assistance, low down payment mortgage options, including a lot of people think that low down payment is only an option in the government lending space. It's also an option in the conventional lending space with products like Home Possible, which allow, as low as 3% down, depending on your other circumstances. So the, more wealth constrained consumers could become homeowners sooner than they would otherwise with these low down payment options that are available in the conventional market as well. And I want to also note that there's a link here or a note in the slide about a map that we put together. This data that I'm showing you here, we've actually decided to make this publicly available. So Freddie Mac has published a map of this first-time affordability map based on the data. The idea that mortgage-ready consumers could afford a home purchased by a first-time home buyer with the same or less income in their area. We call it the Freddie Mac first-time home buyer affordability map that allows you to drill down and get detailed insights into what it looks like for your particular geography, where you can look at it overall, or you can look at it by slicing it for the low to moderate income consumer to understand mortgage ready counts as well as affordability in these particular markets. So I hope that you find that helpful and be interested in your questions related to this as well. Thank you. Oh, Monica, are you still muted with the question? Yeah.
There I am. Awesome. I love that tool. I know that we use it as part of our team all the time, but I know that it's available for anybody wanting to participate and kind of go in there themselves to see in particular their market. So can you give some insights on where attendees can go to get more information on how to utilize the tool?
Absolutely. Do go to freddiemac.com to take a look at the research and perspectives. So if you go to freddiemac.com and usually there's the 3 or 4 bars in the upper right-hand corner of a website, you click on that, research and perspectives will take you to the article that explains the methodology behind the affordability map, gives you all the details. You can interpret the information and know how to use it, as well as a link to the actual map itself, which is interactive.
Love it. Thank you so much for joining us. And thank you, Dr. Lautz, for joining us as well. It's going to be an interesting 2023, and we hope that these insights that our speakers have shared will provide some context to better position your business moving forward. I encourage you guys to follow our speakers here on LinkedIn. They are going to be sharing their insights throughout the year, and we want to make sure that you're staying up to date with the latest trends and insights that they're able to offer. Another way to stay connected to the latest insights is to subscribe to our Real Estate Professionals Resource Center. What you get is Freddie Mac insights directly in your inbox. Be sure to scan the QR code when it appears on your screen to be able to subscribe. We're now going to go into a 5-minute break, but we'll be back with more insights and sessions.